Hello, welcome back again. We're going to be finishing up this chapter now by looking at ratio analysis, methods, liquidity, and the Dupont identity. So this is our part 6, last part, and we're starting on page 96. So, what do we mean by liquidity? In general, liquidity is all about short term survivability. So, one good general definition for liquidity is measure of a firm's ability to quickly produce cash to meet its short term obligations. And there are that said, a bunch of more specialized definitions that people throw around. Here's an example of one: the ability to quickly convert an investment portfolio to cash with little or no loss in value. So an example of where this definition was used comes to us from the Great Recession as reported by the Wall Street Journal in June of 2008. They had an article on Bear Stearns, which essentially went bankrupt. They were forced into sale to JP Morgan Chase by the Federal Reserve at literally almost nothing. So essentially it was a bankruptcy. So one of the issues with Bear Stearns was they thought they were so cool, they had no problems because they had a $40 billion portfolio of stuff. So if they, ran into trouble, they could just sell some of that portfolio. But unfortunately, as the journal pointed out, the portfolio was not liquid. It had a bunch of CDOs in it and other inscrutable stuff. CDO stands for collateralized debt obligations, and no one in the whole wide world would even provide a bid for this portfolio or a portion of it. That's pretty amazing. That's how much uncertainty there was in the world at this time. This was just truly a historic, amazing time. So anyway, just a quick follow-up to that. A bunch of these big investment banks and money center banks had similar portfolios, and the first one to be able to sell any of this junk was Citibank, that in August sold some of its CDO portfolios for 22 cents on the dollar. So that actually wouldn't have been anything like enough to have saved Bear Stearns. Okay, so with some definitions of liquidity in our pocket, let's look at liquidity ratios. So they're always going to be measuring sources of cash versus cash obligations. So the eternal question is bigger better? Well, in this case, it's going to be, I don't want to say it depends again, but it's going to be bigger is safer. And that's going to be true for all of these ratios. And it means that bigger is better up to a point. Investors aren't paying you to have such a huge pile of cash that you have no risk at all. So we'll see how that works as we go on. So what do we mean by sources of cash? We're going to be focused on operating sources of cash, which are things like current assets, or we'll learn soon working capital assets, which are closely related to current assets. Remember, current assets are those assets the company thinks it can convert to cash within a year. Cash flow from operations. If your operations are throwing off cash, that's of course a great source of cash. And also revolving lines of credit, which are thrown in with operating sources very often. And those are really just like a credit card at a corporate level. It's a loan that they can draw on whenever they want to help out their operations, the same way you can choose to pay for things with your credit card whenever you want. Okay, so what do we mean by cash obligations? We're going to be focused mostly on operating stuff again. So that'll be current liabilities or working capital liabilities. Remember, current liabilities are liabilities the company has to pay off in cash within a year. Cash flow into operations. Remember, we looked at GM during the Great Recession, and GM was burning, I forget whether it was 2 billion or 4 billion. Their operations were burning 2 billion or 4 billion in cash per quarter, right? So that means that they had to put that much cash into their operations to build the cars they were building. Not good. And also, interest is an obligation that clearly you have to pay if you have any debt out there. And what about depreciation? Well, you accounting majors, you know where we're going with depreciation, and you know the answer is no, right? And the reason why, let's remind ourselves what happens with depreciation. So let's go back to green car companies, CNC mill, and during a year it wears out by a fifth of its total lifespan. So they want to reflect that, and the way that they record that is depreciation expense. So they expense 20% of the mill's value, and then the other side of that is they reduce net PPE or accumulated depreciation by the same amount. So depreciation never has any effect on cash, right? So it's important to remember that. Okay, so let's think about capital expenditures. Now this is going to be important for liquidity. So capital expenditures is universally abbreviated as CapEx, and CapEx is just net purchases of PP. So that's going to mean purchases minus sales. And for a large steady state company, it's good to know that for something like Procter and Gamble, Walmart, the company's capex is going to pretty much match the decline in the useful life of its PPE. They are growing a little bit, but basically, as things are wearing out, they're replacing them. There's a little bit of growth in there, but not much. And so, formally, that's going to mean for a big, mature, slow-growing company that capex should be about the same as depreciation if everything is working well. And where do we find capex? I'm counting on you accounting majors to know this, and everybody else, let's help them out and tell them CapEx is always found on the cash flows from investing portion of the cash flow statement. All right, so let's look at some particular liquidity ratios. First up, very common, very helpful, is our current ratio. Current ratio just measures current assets over current liabilities. Current assets are clearly a source of cash, and current liabilities are obligations to cough up cash. So what about our three things for this ratio? It's just the assets we expect to turn into cash within a year versus cash obligations we have to pay out in the same time frame, okay? Bigger is better up to a point, right? No investor wants you to build up the mother of all piles of current assets because your company could be doing better things with its resources than that. So let's say, as we're pretty much always going to say with these ratios, bigger is safer. Okay, so both are true. Bigger is better up to a point. Bigger is going to be safer. Okay, and is there a potential knife edge with this guy? Yeah, there's definitely a potential knife edge at 1.0, right? Because you always want to have what you expect to be able to convert into cash bigger than what you expect to have to pay out within a year. So if those two are exactly equal, the ratio is 1. Less than 1 is not good. Okay, usually not good. We'll look at that a little more carefully in a second. All right. For a regulated utility, the current ratio can be really pretty small, right? Because they're essentially guaranteed a profit, almost guaranteed a certain return on equity, so they can sail kind of close to the wind. For a tech company, you want that to be bigger. How much bigger? It's a function of how big that tech company is. Is it heading towards being a monopoly? How safe is its customer base? How potentially in danger are they of being disrupted and totally squashed like a bug, like Nokia was when the Apple iPhone came out? That type of thing. Okay, so now let's look at the working capital ratio, which is closely related to the current ratio. To get this show on the road, the first thing we need to know is what are the working capital accounts in financial accounting? They're all the asset and liability accounts that are associated with our day-to-day business. Okay, so not equity accounts, asset and liability accounts associated with day-to-day business. So another way to think of it is all of our asset and liability accounts that are not associated with financing or investment. And also this is going to have nothing to do with whether they're current or long-term. Okay, so nothing to do with current versus long-term. Okay, so just like we were measuring debt in the debt to assets ratio and the debt to cap ratio, we want all the debt, short term and long term. Same thing is going to be true with the working capital accounts. We don't care if they're current or not. All right, so what are we going to include in these accounts? It's going to be stuff like this. Clearly, we're going to have on the asset side, accounts receivable, inventory, that sort of thing. On the liability side, we're going to have accounts payable and back to assets, prepaid expense asset. Even if there's a long-term portion of that, that's considered a working capital account. So what are we going to exclude from here? Things like short-term portion of long-term debt and long-term portion, of course, of long-term debt, right? PPE, et cetera. PPE, not part of our day-to-day stuff. That's long-term stuff. And of course, not equity accounts, right? Working capital accounts, just asset and liability accounts. All right, so now that we know what the accounts are, now we can define what everyone calls working capital. Working capital is just defined to be our working capital assets minus our working capital liabilities. So what's working capital measuring? It's measuring how much more cash and normal business transitory assets we have than our normal business, day-to-day business transitory liabilities. So another way you can think of it is as our excess of normal business transitory assets. Okay, so bigger, better, worse. It's going to be, as usual in this chapter, better up to a point. So as we said before, bigger is safer, okay, and negative is definitely not good. All right, so now we can build a ratio out of this. So our working capital ratio, right? Okay, our working capital ratio is just our working capital assets over our working capital liabilities. And that should look familiar to you now because it's very much like the current ratio. It works just like the current ratio, except it's really built on better information. Working capital assets and working capital liabilities is better, it's more inclusive than current assets and current liabilities. So we're measuring with this ratio our excess of our normal business operating assets versus our normal business liabilities. Okay, so bigger is equal to safer. Okay, and we have a knife edge here, just like we did with the current ratio at 1.0. Okay, so here's the good news for you all. The working capital ratio is difficult to compute in a fully automated framework like the type of spreadsheets that we've been working with here. In general, to get the working capital ratio right, you've got to look at the notes to the financial statements and really suss out carefully for each asset and liability account, can it be and should it be considered a working capital account? So for that reason, I'm not going to ask you to compute the working capital ratio, but you need to know what working capital accounts are, especially if they're spelled properly, and you need to know what working capital is, and you need to know the working capital ratio. So you need to know all three of these definitions. Okay, next up is our nominal interest rate, or simply interest rate, and the way that this works. And we'll be using this a lot in finance, so this is a good one to remember. So the interest rate is just our interest expense, which we always want to annualize, right? So if we got quarterly interest for the company, what are we going to do with that number? We're going to multiply it by 4, right? So interest expense annualized divided by total debt at the beginning of the period. So this answers the question, given the debt the firm had at the beginning of the period, how much interest did it pay? Or more simply, how much a firm is paying for its debt financing. Okay, all right, now is bigger better or smaller better? Smaller is always better, right? Because we always want to pay as little as possible interest on our debt financing. So clearly, smaller is better. Whoop. All right. And do we have a knife edge here? There's really no realistic knife edge. All right. And one thing that lenders like to look at a lot regarding liquidity is the fixed coverage ratio, or sometimes they'll call it the EBIT coverage ratio. I like that better because it explains better what we're exactly talking about, which is to wit EBIT in the period over interest expense in the period. And remember, EBIT is earnings before interest and tax. Okay, so what this is telling us is the ability of operations to pay interest, right? It's the income that we had, our revenue minus our expenses before our interest and tax, versus how much interest do we have to pay in the period. So clearly, that's going to mean that we have a knife edge at 1.0, right? Because if it's less than 0, we are not earning enough to pay our interest, and that's not good if your operations aren't earning enough to pay your interest, okay? And in this case, again, like all of these ratios here for liquidity, bigger is safer, okay? Or we could say bigger is better up to a point. One thing we're going to find out as we go through is if a financial project, including operating an entity, is worth doing, it's always worth levering. So if we have this ratio of infinity, which means we have no interest payments, probably means that we're not being as smart as we could be with our entity. So once again, if the ratio gets too big, it probably means you're not the smartest entity in the world. We'll see how that works later on in the term. Okay, now we're going to need to think about a ratio with EBITDA in it. So let's make sure we know what EBITDA is. EBITDA is like EBIT, except now we have these two other things, depreciation and amortization. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And the nice thing about EBITDA is it's a good number to look at if an entity's EBITDA is not greater than 0. You really should just give up the ship. You should just declare bankruptcy and go out of business, right? Because if your operations are not positive when you have your revenue and subtract expenses, but not including the subtraction of interest, taxes, depreciation, and amortization, it's just not going to work for you. Okay, so that leads us to the EBITDA sustainability ratio, which is just EBITDA over interest plus CapEx. And this is especially helpful for companies like United Airlines during the Great Recession that might be in danger of going bankrupt, okay? And the way we want to think about this is it's our ability of operations to pay interest and maintenance and growth of property, plant, and equipment. And basically the idea is here, if you're sort of just muddling along, you're just barely making it, what do you really have to pay for with your EBITDA? Well, you definitely have to pay interest on your loans, right? Otherwise, you lose the keys to the firm or you have to go run to bankruptcy protection. And you really have to maintain your property, plant, equipment, and that's done with your CapEx. Especially if you're an airline, you better be maintaining your property, plant, equipment, which is largely your planes. You don't have to worry about tax because if you're just muddling along, you're just going to be breaking even. You're not really going to have to pay any tax. Okay, so bigger is safer with this one, and we do have a knife edge here at 1. 1 is definitely not good. So this is a very common ratio for analyzing distressed companies. So any of you who are interested in that, that's a whole field of finance itself with a subset called vulture investing, which I don't want to get into here, but there's a whole branches of good and not so good areas of looking at distressed companies. All right, so let's look at some sustainability ratios for UAL and Love, and as usual, answer some questions. So I've got my sales and sales growth back, and now I have my current ratio, quick ratio, which we're not worried about. That was a gray page. Fixed coverage ratio, definitely, that's a good one. EBITDA, sustainability, interest rate, and depreciation test, which also we're not going to worry about. Remember, if it's a gray page in notes, we're not worried about it. And again, I have some of these things here that we're not using because this whole package comes from real world analyses where sometimes we do want to look at these ratios. Okay, based on TTM results, that makes me happy. There's only one column I have to look at. Which company best plans for its near-term obligations? All right, so the key here is near term, and that's got to be the current ratio, right? Current ratio, near term, current assets, current liabilities, right? So we want to use the current ratio. All right, so let's go back and do just that, TTM, current ratio. All right, and we have, look at this, surprisingly, again, we have UAL doing better than Southwest. Okay, and they're both bigger than 1, which is good, especially in UAL's case. Okay, so it's UAL. Is the other company unsafe? No. Also greater than 1.0. Okay. Is the trend in UAL's EBITDA sustainability ratio good or bad? And are recent levels of this ratio sustainable? I have no idea, but let's go find out together. So here's our EBITDA sustainability, and we want to focus on, we're being asked for UAL. Okay, and I'm just going to look at a year ago versus this year, and I see, so with this, remember, we want to be bigger than 1 or 100%. So we've got clearly bigger than 100%, bigger than 100, bigger than 100, bigger than 100, bigger than 100, less than 100%, way less than 100%, way less than 100%. So definitely in the last 3 quarters, the trend has not been good. Okay, so we can say here, so this is bad, right? Okay, going down big time. Okay, and our current levels of this ratio is sustainable. Well, let's go back. So in the numerator is EBITDA, and in the denominator is what we really have to pay after our EBITDA. So we want this ratio to be bigger than 1. If it's less than 1, it's definitely not sustainable. So this is not good. No. Not good. Okay. Based on TTM results, which company pays more to borrow money? So clearly we're going to look at the interest rate ratio for that. Here we go. And we're looking at TTM, so we only need to worry about the last column. Okay, so here is our TTM column right here. Okay, and look at this. This is counterintuitive, right? But UAL has a lower interest rate on its debt than Southwest, which is kind of interesting. Okay, so inquiring minds among you, maybe 2 out of all of you, hopefully more than that, might be wondering why this is true. There are several reasons why it could be true, but one is that UAL, and this actually turns out to be true, UAL has a lot of long-term debt that it took out a long time ago before the Great Recession got started, and that was at a very low interest rate. And Southwest has much newer debt, some of which it got as the Great Recession was kicking up. So just because of the generalized panic of the Great Recession, they had to pay a higher interest rate for that. Okay, so that's it for all of our primary methods of looking at measuring the financial performance of an entity using just financial statements. But wait, there's more. There is an alternative framework for this called the Dupont identity. Okay, so it's a completely different thing than our 5 different important types of ratios, right? Our framework had these 5 important types of ratios, and we just finished with liquidity. All right, the Dupont identity is something completely different. It starts with the cardinal importance of ROE, which is a good thing, right? Net income divided by equity. Okay, and it breaks ROE in a kind of clever academic-y way, which I'll show you right here. ROE is net income divided by equity, right? But if we could also say, being very clever, it's net income divided by sales, so that would be profit margin, times sales over assets, which would be asset efficiency, times assets over equity, which is a measure of leverage that we have not used. It's not a very common measure. It's called the equity multiplier. So this is a kind of cute way to look at things. It's pretty much only used, as far as I've seen, by academics. I've never seen a real world practitioner do anything with the Dupont identity, and real world practitioners use these 5 different views on ratios. Okay, but nonetheless, we have to know about it because some academics think it's important and it will come up. Okay, so if we cancel out here, we've been so clever to put these things in, but we can cancel sales in the denominator with sales in the numerator, assets in the denominator with assets in the numerator, and what we're left with is net income over equity, which is, of course, return on equity. So that's the whole deal with the Dupont identity. So it's focusing on these 3 components, like I said. So this is the margins, net income over sales. And in particular, another problem with the Dupont identity is it's only focusing on 3 ratios, which is clearly not enough in the real world. So the only margin ratio it looks at is profit margin. So that's not very helpful. And then it does look at efficiency, which is good, but again, it's only looking at one measure of efficiency, which is sales over assets. And then it is looking at leverage with this assets over equity ratio, which is a ratio that is almost never used in the real world, but people who do use it call it the equity multiplier. We didn't even bother with it because it is so little used. All right, so what are some other problems with, you can see I'm not a big fan of the Dupont identity. What are some other problems with it? It ignores completely sales and sales growth, which is really, really important for the reasons we talked about at the time. And it doesn't talk about liquidity, which is, of course, extremely important, especially when you're in a recession. And all the other ratios that we talked about, all the other margin ratios, efficiency ratios, and leverage ratios. The one thing it is good for is showing the interdependence of margin ratios, efficiency ratios, and leverage ratios, right? Because these are multiplicative and not additive, they're definitely related in a nonlinear way, in an interdependent kind of way. Okay, and that is it for this chapter. Just a quick reminder, Appendix 1 has United's financial statements from which every single ratio we looked at in this chapter and you saw printed on various pages of this chapter came from for UAL. So you're welcome to look at all these, and as you remember, we computed some of these ratios. So that's it for evaluating the financial performance of entities using nothing but financial statements. In the next chapter, we'll look at evaluating entities through their financial statements and also market information like stock prices and things like that. So until then, stay tuned, stay safe, and I'll catch up with you soon.